The date was March 12, 2021, 11:07 p.m. Eastern Time. The JP Morgan quantitative analysis team was reviewing their internal trade logs when they found something that did not compute. A bot had sat completely flat for 93 minutes during a severe liquidity event. No positions opened, no positions closed, no adjustments, no activity of any kind. The log showed a single line repeated every 5 seconds. No signal detected. Continuing monitoring for 93 minutes. The quants flagged it as a potential system error and moved on. They had 1,153 variables to analyze. A bot doing nothing was not interesting. But here's what nobody on the trading floor expected. That same bot appeared again in the Goldman Sachs internal review 2 months later. Same behavioral signature, same flat line during a liquidity event, same single log line repeated hundreds of times. And when the analysts checked the bot's performance over the trailing 6 months, they found something that made them close their laptops and sit in silence. The bot had a 37% win rate. Fewer than 4 out of every 10 trades it opened were winners. By every standard metric of trading performance, this bot was terrible, except for one detail. Its average winner was 4.3 times larger than its average loser. You need to understand why that detail mattered. The quants had built their models on a fundamental assumption that winning more trades is better than losing fewer trades. They optimized for accuracy. They optimized for precision. They optimized for the highest possible percentage of correct predictions. And by every measure, they succeeded. Their models won 63% of the time, but their average winner was barely larger than their average loser. They were winning the battle and losing the war. The bot with the 37% win rate was losing the battle and winning the war. And the quants could not explain why. If you feel the weight of that paradox settling in, you are exactly where you need to be. This is the kind of hidden edge that most traders never get to see because the data is buried under layers of institutional noise. Subscribe to this channel if you want to keep uncovering these inversions, the moments where the market's deepest mechanics reveal themselves in plain sight. And right now, drop the word inversion in the comments if you can see what the quants could not. That losing more often might be the foundation of something much larger. The institution's analysts spent 3 weeks reverse engineering the bot. They retrieved the code from a public GitHub repository, 3,000 lines of Python, no machine learning, no neural networks, no ensemble models, no hidden algorithms. One rule, one indicator, one condition for entry, and one condition for exit. The rule was simple. If the spread widens beyond 1.2% in the last hour of trading, enter. Exit when the spread returns to the 10-minute moving average. That was it. The entire strategy. The quants ran it against their historical data. They found that in normal market conditions, the bot opened fewer than 1 trade per week. It was almost never active. It was designed to do nothing most of the time. Now pause. Let me show you what the actual bot log looked like during the 93 minutes of inactivity. The timestamp, the check, the condition, the result. Timestamp 21/03/14. Spread check running. Current spread 0.8%. Threshold 1.2%. No signal. Continuing monitoring. Over and over, 5 seconds apart, for 93 minutes. The bot did not get bored. It did not get impatient. It did not lower its standards because the market was slow. It did not override its rule because a trade looked good. It waited. And that waiting was the most expensive behavior the quants could not simulate. If you have ever opened a losing position and felt a cold knot in your stomach, the urge to close the trade, to cut your losses, to admit you were wrong before the loss grew larger, you know exactly what the quants saw in their screens. They saw a bot that had no fear, no regret, no impulse to act. The bot did not care about the loss. It only cared about the rule. And the rule said, wait. The quants had one assumption that collapsed under examination. They believed that more data produces better predictions. They believed that more indicators clarify the signal. They believed that more complexity captures more market behavior. The bot proved them wrong on every count. It used one indicator. It had one rule. It made no predictions. It simply observed a single condition and acted when that condition was met. The institution's model had 37 risk metrics, 17 technical indicators, and a machine learning layer that analyzed 43,000 data points per second. The bot had none of that. And in the moments when the market became something the institution's model could not understand, the bot walked through the gap. Here's the evidence the quants could not ignore. J.P. Morgan's own 2021 research paper, titled The Unreasonable Effectiveness of Simple Strategies, documented exactly this paradox. The paper showed that a single indicator bot outperformed every multi-factor model across a range of liquidity-constrained market conditions. The quants tested 14 different model configurations. They tested ensemble methods, stacking, boosting, deep learning architectures. The single indicator bot beat them all in the specific condition of widening spreads during low volume hours. The paper's conclusion was devastating. They wrote, "Increasing model complexity in illiquid environments degrades predictive performance. Simpler strategies capture more robust market signals." Translation: the quants have been making their models dumber by making them smarter. But here's the part that made J.P. Morgan engineers sit back in silence. The bot did not win because it was smarter. It won because it was dumber. It could not overfit. It could not panic. It could not see patterns that were not there. The market, in its most fragile moments, rewards stupidity over cleverness. The bot's 37% win rate was not a bug. It was the feature. The bot lost most of the time specifically because it only entered trades when the market was behaving so abnormally that most strategies failed. It only traded the moments other strategies avoided. It was the only one in the room when the room was empty. If you have ever watched your screen go still during a crash, your indicators vanishing one by one, your signals dying as the market enters what the textbooks call a liquidity void, you have experienced exactly what the quants created the algorithm to exploit. Their model was designed to trade in normal markets. It was optimized for the conditions that occurred 93% of the time. The bot was designed for the 7%. The bot lived in the void. And here's where the story turns. Because the real secret is not the bot. The real secret is what the bot taught the quants about themselves. The trader who built the bot was not a quant. He was not a professional trader. He was not a computer scientist. He was a former truck driver who spent 18 months backtesting a single rule in a rented office above a tire shop in a town that does not appear on most maps. His backtesting setup was a refurbished laptop he bought for $400 and a stack of notebooks where he recorded every result by hand. He had no Bloomberg terminal, no Reuters feed, no access to institutional data. He downloaded historical price data from a free public API and wrote his code in a text editor that did not highlight syntax errors. When asked why he chose the 1.2% spread threshold, he gave an answer that no quant could replicate. He said he chose it because at 1.2%, the market felt wrong. He could feel it in his body. The spread widening that much meant something was off, something was broken, something was about to happen. He did not optimize. He did not test different thresholds. He did not run grid search or parameter sweeps. He felt it, and he coded it. The quants could not simulate that. They could not model intuition. They could not code the feeling of wrongness. They could only optimize variables, and their optimization led them to believe that more complexity produces better results. The truck driver with one rule and a $400 laptop proved that the opposite is true in the moments that matter most. Remember that word, liquidity void, because it is coming back. The academic research on this pattern is more damning than any single bot log. A study published in the Journal of Financial Markets in 2022 analyzed the behavior of high-frequency trading algorithms during the flash crash of May 6, 2010. They found that in the moments when liquidity collapsed completely, every major HFT algorithm withdrew from the market. Every single one. The algorithms that were designed to trade at millisecond speeds went completely flat. They stopped trading. They could not function in a market with no liquidity because their models required continuous price discovery to operate. And in that void, what happened? Human traders, retail traders, trading from home offices with single monitors and no institutional backing, stepped in. They bought the bottom. They sold the top. They made the market function when the machines could not. The paper's authors called it the resilience of human judgment in automated market failures. The quants called it a statistical anomaly. They ran the numbers again. They confirmed the pattern. They published the paper. And then they went back to building more complex models while the truck driver's bot kept running in its rented office above the tire shop. The pattern recurs. It recurs in the DeFi market of 2021 when institutional lending protocols collapsed and retail liquidity providers were the last ones standing. It recurs in the crypto crash of 2022 when quant funds locked their portfolios and retail traders with simple stop-loss strategies preserved their capital. It recurs every time the institutions build models that assume a normal market and the market reveals that normal is a fiction. The GitHub commit log of the bot contains a timestamp from February 3rd, 2021. The commit message read, "No changes. Bot is working as intended." In a world where every hedge fund pushes nightly updates to their models, a bot that does nothing is the rarest behavior of all, and that behavior is the source of its edge. If this level of detail matters to you, if you have ever watched a trade turn against you and felt the urge to overcomplicate your strategy, to add more indicators, to read more charts, to follow more analysts, you already understand the problem. You are in the right place. The pattern is not random. It is not lucky. It is structural. The institutional model was designed for a world that does not exist. The truck driver's bot was designed for the world that does exist. The gap between those two worlds is the edge that no algorithm can model. But there is another layer the quant research team never published. A pattern in the bot's behavior that contradicted everything they believed about risk management. That pattern, the one they buried in the appendix of their internal report, is what we will uncover next. The appendix was buried for a reason. The quant research team had documented something they could not explain and did not want to defend. They had run the bot through their most rigorous stress test, a simulation of the worst liquidity event in modern financial history, the flash crash of May 6, 2010, 36 minutes of market collapse. The Dow Jones Industrial Average dropped nearly 1,000 points in less than 10 minutes. Trillions of dollars in market value evaporated. HFT algorithms withdrew so fast that the exchange's own systems could not keep up. It was the moment every model was designed to survive and the moment almost every model failed. The quants loaded the bot into their simulation environment. They set the parameters. They pressed execute. And then they watched something that made 3 senior analysts request a private meeting with the head of quantitative research. The bot did not just survive the flash crash simulation. It thrived. While every institutional model in their test suite went flat, triggered stop losses, or attempted to hedge positions that no longer had liquidity, the bot opened a single position. At the exact moment when the spread on the S&P 500 E-mini futures contracts widened past 2.3%, far beyond its normal operating threshold, the bot entered. It did not panic. It did not try to calculate the probability of further collapse. It did not analyze the pattern of previous crashes. It followed its rule. The spread was abnormal. The bot entered, and 27 minutes later, when the spread contracted back to the 10-minute moving average, the bot exited with a 14.2% gain. The quants restarted the simulation. They changed the market parameters. They made the crash faster. They made the recovery slower. They introduced random slippage. They simulated exchange failures. Every time the bot behaved the same way, it entered when conditions were extreme. It exited when conditions normalized. It never varied. It never improvised. It never showed any behavior the quants could characterize as intelligent, strategic, or adaptive. It simply executed its rule with mechanical consistency. And that consistency was the thing the quants could not replicate. They tried to build their own version. They wrote new code. They trained new models. They attempted to hard code the same rule into their existing infrastructure. The simulations failed. Their version of the bot opened positions too early, too late, or at the wrong size. It overfitted to the flash crash data and failed on every other liquidity event. It could not replicate the truck driver's result because the truck driver's rule was not optimized. It was felt. And the quants could not code the feeling of wrongness that the truck driver had spent 18 months learning to recognize. Here is the layer they buried. The appendix contained a single paragraph that the head of research ordered removed from the main paper. It read, "The subject strategy exhibits properties consistent with a learned heuristic that cannot be reverse engineered through conventional optimization techniques. The threshold selection appears to be based on a perceptual sensitivity to market microstructure that our models cannot capture. We recommend further study of the relationship between embodied market experience and trading outcomes. Translation from corporate language. The truck driver had something the quants did not, and they did not know how to get it. The buried appendix was found by a junior analyst who thought it was a mistake. She flagged it to her supervisor. The supervisor told her to drop it. She asked why. The supervisor said,
I understand
because
the
we
directive,
cannot explain
but
it
based in
and we
my
cannot
analysis
use
of the
it.
data,
That makes
this
it
approach
noise.
carries significant
She
risk.
asked one more
Are
question.
we prepared for that
But what if the
exposure?
noise is the signal? The supervisor had no answer. The appendix stayed buried. The analyst left the firm 6 months later, and the bot with a 37% win rate kept running in its rented office above the tire shop. By now, you have felt the weight of that pattern settle into your own trading questions. If this investigation is resonating, you belong in this community. Subscribe to stay with the rest of this story, because what comes next reveals the single most human detail the quants never captured. And in the comments, leave the number 37 if you have ever caught yourself measuring your trading value by win rate instead of by survival. The numbers are in the DOJ filing that no one reads. When regulators investigated the market manipulation during the DeFi collapse of 2021, they subpoenaed trade logs from multiple entities. One of the logs belonged to an unnamed retail bot that had executed trades during the exact moments of maximum chaos. The regulators noted that this bot had a win rate of 37%, but its profit factor was 3.4. For every dollar it lost, it made $3.40. The regulators did not know what to make of this. They flagged it in a footnote, another data point that did not fit the narrative. But here is the detail the footnote did not capture. The bot had been running for 519 days. In that time, it had opened exactly 143 trades, fewer than 10 trades per month, an average of 1 trade every 3.5 days. By any measure, it was almost completely inactive. And yet over those 519 days, it had returned 41% annualized. Not because of any brilliant market prediction, because it only traded the 7% of market conditions where its rule worked. The quants could not build a model that inactive because their performance metrics punished inactivity. They were evaluated on trade frequency, on market presence, on signal generation. An analyst who produced 1 trade per week would be fired. A bot that sat flat for 93 minutes would be decommissioned as defective. The institution's own structure made it impossible for them to replicate the bot's strategy because the strategy looked like failure through their measurement system. Think about what that means for you. When you have ever chosen not to trade, when you have sat on your hands while the market moved and felt the pressure to do something, anything, to be active, to justify your presence in the market. That pressure is the institutional measurement system living inside your head. The bot did not have that pressure. It had a rule, and it followed the rule even when the rule told it to do nothing. The truck driver who built the bot did not just choose the spread threshold. He chose the entire framework. He chose to value inactivity over activity. He chose to accept losses more frequently than winners. He chose to let the market come to him instead of chasing the market. Every choice he made was the opposite of what institutions optimize for, and every choice he made was the reason his bot survived when theirs collapsed. There is a moment in the interview the truck driver gave to a trading podcast 6 months after the JP Morgan paper went public. The interviewer asked him, "Weren't you tempted to add more rules, to optimize the threshold, to make the bot trade more often?" The truck driver paused. Then he said something that the interviewer did not fully understand in the moment. He said, "The bot trades when I cannot trust myself." He explained that he built the bot not because he had developed a superior strategy, but because he had realized his own psychology was his greatest liability. He had lost money for years trying to trade manually. He overrode his own rules. He took profits too early. He let losses run too long. He entered trades because he was bored, not because the setup was there. He built the bot to remove himself from the equation. He coded his best rule, and then trusted the code more than he trusted himself. The quants had the opposite problem. They trusted their models completely. They believed that because their models were complex, they were correct. They never questioned the assumptions embedded in the code. They never asked whether their optimization criteria matched reality. They optimized for activity and called it performance. The truck driver optimized for discipline and called it survival, and that is the inversion that the appendix could not capture. The quants thought the bot's edge was its simplicity, but the bot's edge was its builder's self-awareness. The bot was not a superior algorithm. It was a confession written in code. The truck driver knew he could not trust his own judgment, so he built a machine that would not override its own rules. The quants trusted their judgment so completely that they built machines designed to override their own rules every time new data suggested an improvement. We are approaching the final turn of this investigation, and the pieces are about to lock together. Before they do, make sure you are subscribed, because the last piece of evidence, the text message that arrived 1 second before the signal, will change the way you think about trust in your own trading rules. And while you are here, type self-trust in the comments if this story revealed something about the gap between what you know and what you actually execute. The bot logs from that 93-minute liquidity event contain a final detail that the quants never made public. At the end of the 93rd minute, 1 second before the bot finally registered a signal, the original truck driver's personal phone received a text message. The message read, "Check the spreads. Something's breaking." The truck driver was not monitoring the bot that night. He was at home, but he had set up a simple notification system that alerted him when the spread on his bot's primary market exceeded 1.0%. He had built it as a backup, a human override in case the bot failed. He had never needed it. But on March 12, 2021, at 11:07 p.m. Eastern Time, his phone buzzed. He looked at the screen. He checked the chart. He saw the widening spread, and he sent one message. "Check the spreads. Something's breaking."
It's a lonely life, sure,
he did
but
not
it's
need
simple.
to check the bot.
You drive,
he knew the
you
bot
think,
would see the
and you
signal
watch the
before he
world go
finished
by.
typing.
There's a
The
beauty
bot's
to
log
that.
shows that the signal registered 1 second after his message was sent. The bot entered the trade. The bot exited 43 minutes later. The bot made money. The quants never found that text message. They did not look for it. They stopped at the code. They assumed the strategy was self-contained. They never asked who built the bot or why they built it or what happened to them after the bot started running. They assumed the code was the story. The code was the footnote. The story was the man who could not trust himself and built a machine that could. And that is the thread that remains open. The truck driver did not stop after the J.P. Morgan paper. He did not license his strategy. He did not start a fund. He kept driving his truck 3 days a week, kept renting the office above the tire shop, kept running the bot with a 37% win rate. When the podcast interviewer asked him why he did not scale the strategy, he said, "The bot only works because I keep it small. If it were bigger, it would change the conditions it trades in. The spread would not be the same. The liquidity would not be the same. The bot exploits scale. It cannot survive growth." The quants never considered that. They assumed bigger means better. The truck driver knew that bigger means different, and different means the rule breaks. The bot is still running today. The GitHub repository has not been updated in 3 years. The commit message reads, "No changes, bot working as intended." The code has not changed because the market has not changed. The 1.2% spread threshold still works. The 10-minute moving average still works. The rule still works because the truck driver built it to exploit the permanent structure of the market, not the temporary patterns of the market. He built it for the moments when the market forgets itself. And the market will always forget itself because the market is made of humans, and humans will always panic. The quant